G'day and welcome to the Global View on this Monday. I'm Andrew Gagan. Great to have you with us here at AusBiz. Let's check where we finished on Friday. Global equity markets rallied with investor sentiment buoyed by a strong US employment report and signs China is open to tariff negotiations. Wall Street's major indices finishing up more than 1% each, with the S&P 500 marking its longest daily winning streak in more than 20 years. For the week, the S&P and Dow gained 3%, the Nasdaq was up 3.5%, while the small cap index also did well. Stocks, specifically Apple shares, retreated after cutting its share buyback program by $10 billion, while warning that tariffs could add around $900 million in cost this quarter. Amazon closed down slightly after reporting first quarter cloud revenue growth and forecasting operating income that both missed estimates. Excuse me. And other Mag 7 stocks such as Meta and Nvidia rose. Chevron and ExxonMobil gained after both energy giants reported quarterly results, and Block tumbled, mirroring its Australian listed shares after cutting its profit forecast and missing estimates for quarterly earnings. General Motors warned of a $4 to $5 billion hit to earnings, and American Airlines withdrew profit forecasts. And European equity funds attracted the largest weekly inflow in more than a year last week, while US funds saw outflows of around $15.5 billion for a third straight week on continued uncertainty around the impact of tariffs on global economic growth. Well, US job growth slowed in April, with non-farm payrolls increasing by 177,000 after being downwardly revised to 185,000 in March. The economy needs to create roughly 100,000 jobs per month to keep up with growth in the working age population. The unemployment rate held steady at 4.2%. Meanwhile, on the trade front, China's Commerce Ministry said that the US had recently sent messages to China through relevant parties hoping to start talks. China is currently evaluating this, it says, adding attempting to use talks as a pretext to engage in coercion and extortion would not work. The US Treasury yields rose to a one-week high on the release of the jobs data. The 10-year was at 4.33%, the 2-year rising to 3.84%, and the US dollar was slightly weaker. The Aussie rising to 64.5 US cents in the wake of the emphatic election result, which saw the Labor government returns with an increased majority. And Bitcoin is trading at around 94,000 US dollars. Oil prices, well, they've actually tumbled 4% in early trade. They also moved lower on Friday to record their biggest weekly loss since March, as traders turned cautious ahead of the OPEC Plus meeting, with the decision by the group to increase production output for June. Brent crude futures, they were on Friday at least down around 1.5% at $61 a barrel, having lost 8% for the week in fact. Copper was up 1%, iron ore down 1% to $97 a tonne, and gold edged lower and was headed for a second consecutive weekly loss, although US gold futures did settle 0.5% higher at $3,243 an ounce. Well, to get across what is moving US markets, certainly with a view and a wrap of Friday, I caught up with Kyle Rodda from Capital.com.
Yeah, there is, and the Aussie dollar's already up by about 0.2% this morning. So I think the moves will be modest and fairly short-lived. Obviously, it's only a sort of small ripple compared to some of the other larger waves being made in financial markets at the moment with global trade and all the concerns that come from that. But the surprising element here, of course, was that betting markets were sort of skewing towards perhaps a minority government. There was fears of maybe a hung parliament possibly, but this was a resounding victory. Obviously the post-mortem continues as to why that's the case. I don't think it was necessarily any kind of major policy differences between the two parties, especially on economic policy. There wasn't very large differentiators. So as a result, this isn't like the 2019 situation where one party was seen resoundingly better for the say financial sector and the economy more broadly speaking. But nevertheless, the fact that we do have a majority government, the fact that we'll have greater policy certainty going forward is always a good thing. It takes away some political risk and the risk that there is some sort of legislative gridlock somewhere down the line that could make things a little bit more complicated for the economy and for investors to price in the outlook for the Australian economy. So overall a good news, not from the perspective of the victor, but certainly just the nature of the result. And again, we've already seen that a little bit in the Aussie dollar. We might see a bit of a boost this morning in the ASX 200 off the back of that as well.
Yeah, certainly pointing to a higher open. They're also boosted by what we saw on global markets on Friday. Investor sentiment there buoyed, but the prospect of some sort of breakthrough in negotiations between China and the US on trade. But I mean, let's face it, it's China just acknowledging the fact that the US has reached out.
Yeah, more or less. I mean, I guess the term that pops to my head, Chinese whispers at the moment, because, it quite literally is whispers from the Chinese side that we're trying to rely upon to get a helpful gauge on what's actually going on in terms of negotiations. Obviously, there's the kind of bombast and bluster of the Trump administration, which can, bamboozle everybody and kind of, make it very difficult to sort of determine fact from fiction as to what's actually going on. But, we've got the sense now, or reports, that the US last week did reach out to China to initiate talks. The reports over the weekend is that, the Chinese, in terms of their first olive branch or first step, is trying to sort of nut out that fentanyl agreement and what that might potentially look like to sort of curb the flow of that into the United States, and for concessions, of course, from some tariffs. The concern is how this, how long this drags out, because in the data, broadly speaking, we haven't seen that much damage just yet done by the existing policy uncertainty or the tariffs themselves. But with the exception of some tariffs from semiconductors, maybe some auto parts and other tech components, we're still seeing largely a 145% tariff rate applied on China, which is extraordinarily high, and can only be worn so long by consumers as well as businesses, who I think for the most part are hoping that this will resolve in some way, if not obviously complete removal, then certainly a large reduction of tariffs, and that they can kind of just wear a couple of months of pain without having to really significantly hit investment decisions and significantly and permanently hit hiring conditions as well. So the fact that we're seeing that thawing is very positive. We keep getting these headlines that trade deals are just around the corner, which would be a remarkable turnaround time for considering how long these trade deals often take to nut out and more or less come to some sort of point which is satisfying for both sides, and not only that, just for the financial markets. But the fact that more or less the narrative has shifted and the Trump administration seems to be wanting to sort of drip feed us good news about trade means that investors are just kind of climbing that wall of worry at the moment and buying into that good news. So, positive developments, not very substantial just yet, but certainly heading in the direction that's, positive for risk assets and, forcing investors to price in some upside risk here.
Now, Kyle, oil has been under tremendous pressure, obviously, on the prospect of lower global growth. But this morning you make the point that OPEC Plus looking to increase production, putting further pressure on that oil price.
Yeah, sort of incrementally increasing output going into November by about 400,000 barrels a day. And there might be a number of reasons behind this. Of course, you noted that the weaker global growth backdrop has been a major driver of weakness in oil prices, but you counter that with the fact that at the same time there was also the supply side sort of double whammy, where OPEC was already going to step away from sort of those quote unquote voluntary production cuts that it implemented a few years ago to put a floor under the price of oil, which was somewhere around $65 if you looked at the West Texas Intermediate contract, give or take $1 or $2. But the development over the last few days has seen that Saudi Arabia, ostensibly to punish non-compliant countries like Kazakhstan and Iraq, will increase production more or less to undermine the advantages some of those countries had by not sort of sticking to the output rules. There is also the speculation to what extent this is being done to appease the Trump administration. Obviously, the Trump administration had campaigned on lower oil prices. There was that kind of fairly vapid drill baby drill mantra that was fairly prevalent going into the election campaign, which sort of stands in quite contrast to wanting lower oil prices from obviously the more major OPEC producing countries. But nevertheless, not only is this happening in the context of what's going on in energy markets, but the Saudis are preparing for a visit from the United States to discuss an arms deal as well as a nuclear deal. And there is some sort of suggestion there that maybe the Saudis are trying to butter up the Americans by keeping oil prices low. Certainly Trump seems to have successfully jawboned them lower and produced for themselves some favourable terms on what's obviously something fairly crucial for the for the kingdom's security. So at the moment, we've got oil prices down by about 4% at the open, gap lower. We're about to test the lows of that kind of Liberation Day panic a few weeks ago at about $55 on the West Texas Intermediate contract. Could be interesting for the energy players today. Could be interesting for commodity currencies, and also has an impact on inflation expectations as well at a time where there are concerns about what impact, whether lasting, temporary, big or small, tariffs will have on prices going forward.
And Kyle, look, a big week ahead. We've got interest rate decisions from the Fed, also the Bank of England as well.
Yeah, the BOE looks like it'll cut rates again by 25 basis points, but of course the Fed will be the interesting one because they've been dragged over the coals, or Powell's been dragged over the coals over the last few weeks. Some of the commentary over the weekend from Trump was still pretty nasty towards the Fed chair, and effectively what the Fed's worried about now is sort of walking that kind of very fine balance between trying to manage their employment side of their mandate while also they're managing the price stability side of their mandate. There's this one element that the Fed's worried that if it cuts interest rates because of slowing growth, but there's a price shock through the economy because of tariffs, it'll lead to that kind of 1970s like unhinging of inflation expectations, which means the problem might start to get away from them, or that at least they'll start to stimulate in a sort of a more supply constrained environment. The flip side of that, though, is that they're very cognizant this is going to be a growth slowdown. There is the element that although it's probably unlikely we'll see runaway inflation here, there'll almost certainly be some degree of price shock. And as a result, it becomes a question of how what the Fed's reaction function happens to be to some of this data as it comes through. If it does suggest prices are picking up a little bit, do they continue to cut because employment is weak, or do they hold off and let the labour market weaken even further just to make sure that they're not stoking the fans of inflation? So recontextualizing effectively what the Fed is thinking about in terms of the economy and its reaction function will be crucial at this meeting. The markets are still pricing in that interest rates will come over the next couple of months, but there's been divergent opinions amongst Fed speakers as to what that'll actually look like. Powell's been quite sort of reticent on the subject. Chris Waller, some other sort of more dovish people are suggesting that there'll be cuts. So no move expected this week, but it'll be really crucial, and inevitably when it holds interest rates steady, there's going to be a stream of truths or social media posts from Trump talking about how Mr. Too Late and the stiff Jerome Powell is not doing his job well.
Kyle Rodda from Capital.com. Righto, let's focus on the local market just before we get underway. SPI futures indicating a positive start of 0.4%, clearly in the wake of that election result, plus some buoyancy we saw there on global markets on Friday. Stay with us, the open is just a couple of minutes away.